Hello everyone and welcome back to episode 2 of my chart analysis series where we will be analysing something slightly different to a normal or ordinary currency pair. Given the recent geopolitical conflict between the United States and Iran, I thought it would be quite interesting to analyse these events and take a look at how they then translate onto the charts. So when something like that happens in the world, investors shy away from the major currencies such as the US dollar for fear of the unknown, fear of potential conflicts and geopolitical turmoil, and therefore they momentarily park their money into the so-called safe havens, such as the Swiss franc, the Japanese yen, but also major commodities such as gold. And gold is exactly today's topic, and the chart that you're looking at now is the 4-hour time frame of the relationship between gold against the US dollar. In order to understand what we could be expecting over the next couple of days, it's important to analyze the correlation between the two. So when the value of the US dollar increases, the price of gold tends to decrease. This is because gold becomes more expensive in the other currencies, and as a result, there are fewer buyers, demand goes down, and price will go down as a result as well. So now that we understand the inverted correlation that exists between the two, we can take a look at the fact that after the geopolitical turmoil began, we broke impulsively to the upside because investors rushed to safety on increasing US versus Iran tensions and clashes that we just talked about. So this descending channel was nicely broken to the upside. So we got 1, 2, and 3. 1, 2, and 3. The pattern was confirmed. It was clear. It then tested this, the 90% rule that was confirmed, like we discussed in the previous episode. But then what happened here? The new all-time high since 2013, which was a big deal, was reached, and then it went straight back down. Okay, that could be correlated to a combination of technical factors as well as fundamental factors. So this is where the research comes in. I was reading this article, a volatile week for gold, which was indeed volatile, and it said that the high achieved on Wednesday occurred immediately after Iran launched a missile. So the high achieved on Wednesday would have been here. So this period here, the whole movement up here, this is a 4-hour time frame. After that, then the lows achieved yesterday occurred as a result of the outcome of that missile launch, resulting in 0 casualties. Okay, so we can see how these news directly correlate to the chart. So missile and then peaceful sort of result or outcome. So we can see then, because of the fact that all of these things have been happening, technical analysis comes in to then predict what will be the next potential or likely next outcome. So we can see that by forecasting this this price action, we can expect price to then break to the downside once again, to then retest this level by creating another 90% rule. So impulse, like we discussed in the previous episode, impulse, correction, impulse. That is happening right here. Okay, so after that, we can then expect price to go down, and if that breaks the 90% rule, we will go down once again towards this level, which is where price impulsively broke out of this downtrend structure. Okay, so there's a couple of things that could happen. Either what we just talked about, or even something called a head and shoulders. So head and shoulders is one of the most discussed and used and known patterns within the technical analysis world, whereby we can identify a left shoulder, a head, like pretty much like this, to then expect another right shoulder, which in this case would be more towards the extended scenario, such as that, whereby price could go up and then retest it to then go down again. Another very important part of the left and head and shoulders pattern is what we call neckline, which in this case would be this the red arrow that I've drawn here. So we can see that happens to coincide, and that's not a chance, with the orange arrow. And that's a very important factor because whenever we try to predict future movements, it's important to find several factors of confluence, meaning do they all align towards the same signal? Are they conflicting? Are they clashing? And in this case, in this scenario, it seems as though it would continue to the downside. How much, with what importance, with what momentum? Well, we don't know that, but by using this bars pattern tool, we could try to anticipate that by copying and pasting this, flipping it onto the other side, and then thinking, okay, if that then breaks, let's make it like this so that it's easier to understand. We can then place a short position just on the break of this ascending channel after the impulse, with a break just above here, just in case it then decides to pull back up, with first here for a 2.41 risk to reward ratio. But if that gets broken, then this trend line and so on and so forth. But for now, this is where I would be looking at taking profit without being too ambitious, because we don't know, again, given the turmoil that could continue over the next couple of weeks. So that could happen because of a couple of confluent factors that we discussed about. So the impulsive break here, the head and shoulders, so that would be 2, and then impulse, continuation, impulse, so that would be 3, and then the fact that something that I will be introducing now also depicts a similar picture. So what we just said is the fact that the US dollar behaves in an opposite way to the way that gold behaves. So when gold goes down, we're expecting the dollar index to go up, and the dollar index is called DXY. So the DXY is an index or a measure of the value of the US dollar relative to a basket of foreign countries. So as you can see here, every currency pair is expressed with a value, so 1.112, relative to another. So the euro is not worth that in itself, but it's only worth that compared to the relevant currency that is compared against. Whereas for this scenario, it's slightly different. So the DXY is just an explanation of the strength as a whole of the US dollar. So we can expect the index to go up when the US dollar gains strength when compared to other currencies. Okay, so what we just said previously is the fact that gold, we're expecting a downside. So in theory, if that held true, then we're expecting a potential upside for this specific index. And well, it could happen because of the fact that we're looking at this outer structure, so impulsively up and then correctively down, and then this could break either by retesting this or by continuing here, finding a double bottom, so 1, 2, so first bottom's double bottom, with an arching nature like that, that would perfectly align with an impulsive break to the upside. That's also confirmed by something called the Fibonacci retracement. Fibonacci retracement is a tool that we could utilize to, I will show you, to say, okay, the impulsive break goes from there up to here. What could we expect to be the major levels? This one here, that was retested 1, 2, 3, 4 many times, here as well, and here as well. So we can anticipate that this Fibonacci structure held true because it was respected here, here, and so forth. So what we could expect is a break to the upside, then a retest of this level, break, and to the upside here, or around this area roughly. So once again, we can see that the DXY index aligns clearly to what we predicted with the gold analysis, and therefore we're expecting a short position on the gold, and contrarily a long position on the DXY. So this is briefly my analysis on the two major pairs, and I just wanted to ask if there were any questions about what I go through, whether you're finding the concept to be too complicated, too vague, too detailed, actually, or too boring. Okay, so let me know about everything that you've listened over the past couple of episodes, and if you would like me to cover a specific currency pair or a specific index or maybe oil, please let me know and I will do everything that I can to do that. Okay, thank you very much for listening, and until the next one. Cheers.